Good morning and welcome to the FLOWTECH FLUIDPOWER PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of the screen. Just simply type in your questions and press send. The company may not be in a position to answer every question received in the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to CEO Mike England. Good morning to you, sir.
Good morning. Thank you. Welcome, everybody. We really appreciate you taking the time to join this call live or listening back on the recording. We're going to be talking today about our 2024 full year results. And for those joining us for the first time, everything we do at FLOWTECH is focused on keeping business moving. And whether that's supplying a single product or designing and building a complex engineered solution, we've made some extremely strong progress in bringing our business together under the One FLOWTECH brand. And we'll talk a bit more about that as we go through the presentation. So a quick introduction, as we've just said, I'm Mike England, I'm the Group Chief Executive Officer. I've been with the business now almost 2 years. It's been a really exciting journey. It's been one of change and transformation. Again, we're going to talk a little bit more around that. I come with over 28 years of experience within industrial distribution and services. So it's been great to get my teeth into the challenge and opportunity at FLOWTECH. And I'm certainly as excited now, if not more, about the opportunity ahead of us, irrespective of market dynamics, than I've been at any point, because I think we're now sitting in a much stronger place than we have been with the changes that we've made. We'll come on to that. Russ, quick introduction.
Yeah, morning everybody. Russell Cash. I've been in role for almost 6.5 years. So put another way, about 30% of that period has been in the post Mike England era, which I'll come back to that later in the presentation.
Thanks, Russ. So just 3 areas we're going to cover off today. We'll give a very brief summary, an overview of 2024 performance. Again, for anybody that's new to the FLOWTECH story, we're just going to quickly explain a bit more about our industry and about FLOWTECH. We're then going to spend some time looking back on 2024, and then we'll actually spend a good bit of time just talking about 2025 trading, where we're focusing and doubling down in terms of our growth efforts, and also the outlook, which I'm sure there's a lot of interest around, given we're now merrily into April. Just a picture, a point of reflection. This is a new infrastructure project which is connecting Northern Ireland and the Republic of Ireland. And this is being built over the course of the next 2 years. We were very pleased in Q4 last year to secure the hydraulic content of this project, so just over 4 million in value. And we're excited to be involved in such prestigious projects like this. And it's just a good example of the progress that we're making in scaling the business up and really being considered for these types of projects. So let me get straight into a summary overview. I guess if we look at 2024, I break it down into two parts. It was a very, very important year of transition. We set in place the strategy, which I'll come on to, and the plan towards the end of 2023. So 2024, with the assemblement of a new team, we were embarking on quite a material transformation of the company in 3 real areas. One was a simplification of the business, bringing 17 brands into one FLOWTECH, and really strengthening our capabilities in doing that and restructuring the business so that we could scale up for the future. We've made some material improvements and continued improvements to customer service and our focus on the way in which we service our customers, and putting in place some of the basics, and also firing up our sales activities, and putting in place some simple things like order book management and a strong sales pipeline culture within the business. We also, and the third point, have made significant operational progress, and we'll come on to some of the fundamental basics, which we've been very proud of in terms of, again, setting the business up for future growth. So the business transformation is essentially complete. So we're pleased that we've made good progress during 2024, and that means that we enter 2025 on a very solid and scalable platform, whereby we can look at a period of stability and that real focus on growth. We've also been pleased to welcome Thorite to the company, an acquisition that we made at the end of August last year. Again, we'll say more about that. And more recently, in March this year, another acquisition of Allswage. Again, we'll talk to that shortly. In terms of performance, fair to say that I think it's been a challenging year for most businesses, particularly within the industrial space. It's been a tough market and a tough backdrop. On the back of that, we do believe that we've continued to drive market share gains in what's been that more difficult market, certainly stiffening more into the second half of the year. We'll talk more about that in terms of how the year unfolded. We've continued to make very strong progress around price management and cost management, and we'll come on to gross margin management because we've seen some good gains there. We have focused and doubled down very hard around our cost base, made some significant cost savings within the year. Russ will talk more to that. From an EBITDA point of view, certainly we've declined in EBITDA. We're in line with the revised expectation, but that really reflects the operating leverage in reverse, really. As a distribution and service company, typically we do have a higher fixed cost base, and whilst we've done everything we can to manage our costs, we do want to make sure that we maintain and sustain the service to our customers. And I'll come on to it during the presentation. But what we haven't seen is a reduction in the frequency of order. We've seen a reduction of the value of orders into our business. There's also some slight dilutive impact of Thorite in the second half of the year. I'm really pleased to report that we've rectified that as we enter 2025. Net debt broadly flat, but we're very pleased with some strong cash generation. And we've doubled down again on some very strong working capital management and some positives there around continued efforts to reduce our inventory, for example. So in summary, we sit here today very steadfast, very determined, very confident in the plan that we have. And whilst we continue to see a lot of market uncertainty around us, we continue to march on with our plan, and we believe that we're on a very strong footing. And with that, I'll pass over to Russ, who's just going to talk about how we've controlled the controllables in the year and just give a brief summary, and we'll come back to that a bit later on in the presentation. Russ.
Yeah, thanks, Mike. I guess slide 5 is a busy slide. That points to the fact that we believe that we have achieved an awful lot, certainly in the last 2 years, under the new leadership regime. I'm actually just going to talk about 2 of the 6 boxes on this slide. That's because the remaining 4 are covered later in the presentation. So in terms of the web traffic, we're poised to launch what we believe is a materially better web experience in the very near future, actually, the next few months. But already we've managed to get the web traffic increased by 2%. So the new website is coming soon. We're very confident it will be an altogether better experience because, candidly, we did have some negative feedback a couple of years ago in terms of that. So that's an exciting area which we've been able to control, notwithstanding the market we've been operating in. The other one I just mentioned briefly, as I said, 4 of them will be covered later, is own brand, where we actually had 11 own brands and we brought them all together under one own brand. That own brand is called FT Pro, and it actually has performed very well in 2024. Its share of our overall revenue has increased, and fairly obviously the own brand products come with an attractive gross margin. So the danger is we try and demonstrate to the audience how hard we've worked, but I will come back to those other 4 boxes in a few minutes' time on later slides.
Thanks, Russ. So for anybody that's new to the FLOWTECH story on today's call, and for those that do wonder from time to time what we mean when we talk about fluid power, thought I'd just very briefly explain. Fluid power is utilised in pretty much every industrial powered system that there is, whether that be on a digger, a tractor, a ship, whether that be within a food factory, offshore, within the utility sector, within infrastructure, within defence, aerospace. Very, very few applications actually across industry doesn't have some form of fluid power within it. That breaks into two areas, hydraulic and pneumatic technologies. Hydraulic is liquid and pneumatic is gas, and that effectively generates and controls and transmits power. And the way I always look at it is that hydraulics tends to do the big lifting and shifting. So you tend to find that hydraulics is very prevalent within areas such as construction, agriculture, defence, oil and gas, heavy machinery, anything where there's a higher load. And pneumatics, which is air, is very much where you see everything moving very, very quickly. That could be to do with food processing or electronics or medical, automotive or packaging industries. So it really is very, very broad. Typically, the market can break down with hydraulics being always the bigger proportion. Here we've got a data point of around 78%. That's still a very, very fragmented market. Pneumatics is a little bit more concentrated, albeit there's still consolidation to be made there. And you can see under core products the typical types of products that we're detailing there. And certainly from a FLOWTECH point of view, we're very proud not only to be able to supply the product across fluid power, but equally we're very proud to be able to design, build, install, service and repair fluid power applications. And what I would say is that there are other power sources, being electrical and mechanical, and with the emergence of sustainability as a key macro theme, and the emergence of sustainability and also digitization and connectivity, we're starting to see a real convergence across what we call a world of motion, whereby we're seeing electrical, fluid power, mechanical and electronics all coming together. And so when we think about our market, actually what we've started to do with our strategy, which I'll come on to, is look to see how we can expand our offering more into that world of motion, which opens up a 30 billion opportunity for us in Europe alone. It's a big and fragmented market. We've got less than 1% market share as a business today, and we've got less than 10% UK market share in terms of our total addressable market. So plenty to go at and plenty of headroom for growth for the future. At a glance, we're the leading fluid power products and service specialist today, certainly within the UK and Ireland, and we're fast looking to grow that out of our business within the Benelux and also then into wider Europe. We have over 620 highly skilled technical people across the business. That number has reduced, albeit it's increased because of the Thorite acquisition. We'll come on to that a little bit later. But we're very proud of the people that we have across our business. We operate out of a number of locations within the markets where we have those operations, UK, Ireland and the Benelux. We do also export, but we're very much focused primarily on our indigenous markets with a very small amount of export today. And we're very, very proud to work with some of the biggest global brands across the fluid power and motion control space. Some of those brands are detailed on the right-hand side, global brands, many of which have got primarily European stock holding, and we're the largest stockist in the UK and Ireland of products within this space. We have two very, very distinct areas of focus in terms of how we go to market. The first is we're a high service product distributor, and that's where we believe that a transactional web platform that's operating very effectively can really be a good springboard for growth. And we also provide a very, very strong master distribution service to the indirect channel, supporting small, regional and large national distributors within this space by giving them access to white label capability and also access to over 30 million of inventory. But we also have a number of our locations where we manufacture, service and repair hydraulic and pneumatic applications. And it's very important to have that local capability. And we believe that by bringing all of this together under one FLOWTECH with a common purpose and a very, very clear and concise value proposition, which is what we've done during the course of 2024. There's much greater clarity now in the market as to who FLOWTECH is and where FLOWTECH is going for the future. Our strategy, we set this out clearly at the end of 2023, and it's really focused on unlocking FLOWTECH's full potential. As I said before, when I joined the business, we were operating under 17 different brands across those geographies, and it was operating quite fragmentedly. And what we've been doing is connecting this together very much under a new simplified operating model. We've broken our strategy down into three very simple pillars. The first is putting the customer at the heart of what we do, but essentially that's about really focusing on a targeted customer base, making sure that remains diverse. But it's building that omni-channel approach, and that very, very much is digitizing the business and starting to really build the capability to be able to harness the power of data. And I'm pleased to say, as Russ has mentioned, that we're very, very soon to be in a position where we're going to be launching that new end-to-end digital platform, which we've been working on for over 12 months to make sure that we build that in the right way. The second is the power of one. And again, I would say that the vast majority of this activity has taken place in the last 12 months, which is launching a new value proposition, being very crystal clear on how we're going to market and what our offering is, but also bringing the whole company together under the one FLOWTECH brand and simplifying the way that we work. That means that there's far greater opportunities as we go forward for upselling and cross-selling all of our capabilities to all of our customers. Previously, they would have been operating much more independently within separate business units. And finally, that world of motion, expanding out our product services and geographical reach into that broader world of motion space. That opens up a 30 billion market opportunity in Europe. We do believe, and we're very confident, that this business has the potential to move to mid-teens EBITDA margins. And we do believe that we have an opportunity with the enhanced capabilities that we're building to outgrow the market times two. In 2024, and again, we'll summarize this as we go through, extracting from the strategy some of the key areas of focus. We break this down into sales growth levers and gross and operating margin levers. We've relaunched the brand to the market, so there's far clearer customer messaging around FLOWTECH and what FLOWTECH is all about and how we go to market. We've really focused on driving sales force effectiveness. We've brought together all of our sales teams into one sales organization, so we're much more unified in the way that we're operating. And we have a single view of the customer. We've built a data integration layer so that we now have complete view across the enterprise of all of our customers in a common customer data platform. We've got an improved digital platform and website coming on stream through this quarter, but we've also been spending time, as Russ has mentioned, improving the existing web platform. So at least, despite the challenging market conditions, we've been able to drive improved traffic within that environment. We've been doubling down on the service levels, and again, we'll give you some statistics to demonstrate not only service level improvement, but also doing that by driving improved efficiency in the business as well. With the acquisition of Thorite and also more work to sign additional brands, we've expanded our products and service range in the year, and we're very proud of the own brand growth since we've done the rebranding to FT Pro. And then in terms of the gross and operating margin levers, that's been very much focused around these four areas of price discipline, which is driving improved gross margin, leveraging our group's purchasing power, so building a capability to harness the spend that we have as a group, building a procurement function that we didn't have before, a group procurement function, really focusing on high margin products to market, and making sure that in all areas we're improving operational efficiency and operating for less. So strategy on a page. Russ, would you just talk then through the 6 margin growth engines in terms of the framework here?
Yeah, thanks, Mike. So the previous slide highlighted our ambition of achieving a mid-teens EBITDA margin. That's a stated ambition, but that is underpinned by our plan, which is centered around 6 EBITDA growth engines. And within that, each engine has 3 key components, so 18 components within that. In order to get there, I think our top line has to grow to something like 160, 170 million. That's how we achieve that. But within each of these, certainly the first 5 of the 6 growth engines, there's material financial benefit attached to those. We can point, and we will do in later slides, to what's come through under the heading of commercial excellence and operate for less. But fairly obviously, we need engine number 1 to get started and up and running properly and maturing. that's been a bit challenging in the last 12 months for fairly obvious reasons. But yeah, each of those in isolation has material benefit. And when we get all 6 of them properly firing, that's when I do believe we get to the 160, 170 top line, and more importantly, that mid-teens EBITDA margin.
Thanks, Russ. And as we've shared before, this slide, it's very much around a focused and staged delivery in the deployment of our strategy and the deployment of our plan. And as we're initiating, developing, advancing and embedding those 6 EBITDA growth engines, we're doing that in a what we believe a sensible way and a measured way, of which 2024 was very much around getting the bulk of the fundamentals in place around the transformation, moving to that one FLOWTECH, driving selling effectiveness, the digital replatforming work, the data integration work, and ultimately driving greater efficiency through our operations. But the principal focus that we set out to achieve was on commercial excellence and operating for less, whilst we started to develop and advance in other areas. When we looked at this back at September at our half-year results, and for those of you that still have a copy of this, we were expecting to see an improvement in the industrial markets through the second half of 2024. That was where the market saw that happening. It's where our suppliers were indicating that that was their view, and it was certainly where the British Fluid Power Association felt that was moving towards. As it was, we saw a continued deterioration in the market through the second half of the year, which is well documented through PMIs. And also industrial production output, which again we can come on to. And so we've just put in that redness of the market disruption. And certainly until a few weeks ago, our belief was that that market disruption was going to continue through the first half of the year, but then we'd start to see some improvement in the second half of the year. We'll talk about it in terms of outlook. The reality is we just don't know really what the year brings. And what we do know is that we still have a fair amount of self-help, and we think more self-help than we originally thought. And we're also focusing and doubling down in a number of industry segments where, irrespective of global trade wars, we believe that there's still opportunities for us to drive good incremental growth. We remain very steadfast on the CapEx investments that we've been making, most significantly improving efficiency of our operations within our fulfillment centre, and secondly, building the new digital platform and data platforms. We will have some further work to do around technology consolidation at some point in the future, but actually I think with the data integration layers we're very comfortable with where we are in the way that we've integrated the businesses so far. But and I think that's what I said at the beginning, I do think that the adverse effect of the dip down in top line revenue, and we'll come on to that because it is very concentrated within some specific customer cohorts, that has had an impact on top line revenue, which has then created that sort of negative operating leverage, certainly through the second half of 2024. But we do believe, and we are very steadfast, that we will continue to show improvement to where we were in 2024 into 2025 on that very stable platform and that stable footing as we go forward.
Okay, so looking back on 2024, 24 obviously in many ways was a challenging period. We're not happy that revenue reduced, we're not happy that EBITDA reduced, but in terms of and it probably links to a question that's popped through in terms of the culture at FLOWTECH actually. But when I personally look back at 2024, probably the best moment was shortly before Christmas, when we were on a call with the still fairly recently inherited Fluorite business, a 174-year-old business that had gone into administration. The picture, by the way, is outside the head office in Bradford. And the question was a simple one. It was, how do people feel? Because we can talk about financial measures as much as we want, and as regards Fluorite, they're really quite impressive. I'll come back to that on a later slide. But in terms of the comments we got back about how are you feeling, incredibly positive. They felt refreshed, energized, part of something which was going places, as compared to something sadly at the other end of the spectrum before we acquired the business. So the question around culture, they feel very part of the FLOWTECH family. I think everybody feels part of the FLOWTECH family now. We've now got different members of the family talking positively to each other, perhaps as opposed to operating in the separate business divisions, which was the case previously. So the mood in the camp is good. It's helped by things like every single person in the organisation has a bonus mechanism linked to the overall performance of the group, not just in terms of profit, but in terms of cash management, actually. So I've taken the opportunity there to answer one of the questions that have popped through. Turning to the financial highlights, just say a little bit about each of the key areas, becoming slightly conscious of time because we do want to give justice to the questions that are popping through. But revenue, 8.6% down, like for like. Obviously stripped out the Fluorite impact there. Fluorite was the best part of 5 million of revenue in a 4-month period. And in terms of the story of the two halves, sadly the second half, where the market got really challenging for us, was almost 12% down like for like, as compared to the first half, which was down but by 6%. When I talk about the segment performance, I'll come back to some specifics within that, notably in Ireland in the second half. And in fact, the like-for-like revenue in H2 was 47 million compared to 56 million in the first half. So that just shows the delta there. Typically, we'd expect H2 to be a little bit softer in revenue terms than H1, but not to that extent. But I think, as we pointed to previously, if anything, an 8.6% reduction is better than the market overall. That seems to us, from what we can see, pointing towards more like an 11% reduction in terms of the markets in which we operate. So we're not saying 8.6% reduction is good for the avoidance of doubt, but we do have some evidence that other people are struggling at least as much as we are. I guess Fluorite going into administration is an example of that. I guess Allswage going into liquidation is an example of that. We've bought both of those businesses, and in both cases, we've not paid much for them. I'll come back to that. In terms of gross margin, I'm going to stick with my headline from 6 months ago. We're operating with a gross margin that's 300 basis points better than any point in the previous 5 years. And we feel that there's still a journey to go on under that heading. There's reference in a previous slide, I think, to 1.2 million of direct and indirect cost savings. Some of that is housekeeping in terms of making sure you're paying the right amount for utility bills, by the way. But some of it is beginning to be more grown up in terms of our product procurement savviness. Not just in GB, by the way, it points towards Benelux, where our Benelux team has invested in some really good quality people. Our operating overheads, we feel, are nicely controlled, but equally there's a balance in there because we have, in our opinion, sensibly invested in certain OPEX areas, notably within that building some in-house digital capabilities rather than being overly reliant upon third-party providers. We think that was a savvy investment. And we have reduced headcount, fractionally, I suppose you would argue, 2.2% reduction. And in particular, in the back end of 2024, we took steps to remove a number of permanent heads and equally some consultants that were operating within the business. And that has impacted to the tune of probably 2.5 million in terms of 2025 cost base. Had we not done that, our OPEX would have been running at about £200,000 a month higher than it actually is. So we think we're managing that well and sensibly, but in a balanced way, because at some point we're going to achieve top line growth and need the infrastructure that we've developed. The debt position is stable. There's some questions popping up and I'll sort of tackle those now. We haven't breached any banking covenants. We're comfortable, very comfortable with the debt that we're carrying. Yes, we do need to improve the EBITDA. But you know, that's entirely manageable. And I think the cash from operating activities points to that. In a year in which the EBITDA has sadly been materially reduced, 3.5 million down, it's nice to see that the cash from operating activities has actually increased by 0.8 million. There's a working capital comment within that, of course, which I'll come back to. Impairment. You see there's a very material impairment charge. It's obviously a separately disclosed non-cash item, and it does relate to activity undertaken between 7 and 11 years ago, historic acquisitions. But in terms of that, I think a number of the audience will understand that the key assumptions that underpin that are related to revenue growth and the discount rate that gets applied to a relatively complex algorithm. And the growth assumptions we've used there are very conservative. We strongly believe that we'll outperform those growth assumptions. But obviously, when your assumptions are being scrutinised by parties, then you have to be conservative, and that does sadly throw out a fairly material requirement to impair goodwill. So we're now carrying, I think it's 13 or 14 million of goodwill into 2025, as opposed to a materially bigger number a couple of years ago. In terms of dividend, well, we do, as I said, we have got a very comfortable position with the bank, a great relationship. We've not breached a covenant, but we do recognise that, that leverage isn't in a perfect place. So, we've decided that rather than paying what amounts to 1.5 million of cash out for dividend purposes later in the year, we're going to retain that. And we expect there to be opportunities that surface, not dissimilar to your Thorites and Allswage, which we feel that pot of money will help us capitalise on, and the return on that capital is extremely attractive. Over and above that, moving on to the next slide, I think, actually, Mike. So in terms of the segments, all three of our geographies have suffered decline in revenue. I've given you the H1 versus H2 split, but just to build a little bit on a couple of things I mentioned. In Ireland grew really nicely actually in 2023, and against a strong comparative, its revenue was down by about 20% in the second half of 2024. The biggest single reason within that is that the crushing and screening sector, which is concentrated in Northern Ireland, actually was a significant down trader. A market that was delivering 6 million of revenue for us a couple of years ago was delivering roughly half of that in 2024, with real negative trends in the second half. Pleasing to say we're seeing some green shoots right now into 2025, but I use that by way of an example of the significant down trading sector. We could also reference, and may well do, some significant down trading customers. Now they are down trading, and we're confident that that will return. And and if you add some of these up, they're really quite material actually, and do explain the lion's share of the like-for-like sales reduction. The other point I'd probably just pull out here is in the Benelux, where throughout most of 2024, if you thought the GB PMI stats were a bit depressing, they were even more depressing in the Netherlands. So unsurprisingly, the top line slipped by about 5 or 6%. But we have invested in a new management team in the Benelux under the leadership of Francisco Terol. He's brought in some fabulous people to support him, and we think that business in particular is set up beautifully for future success. They've just moved to some new premises on the Rotterdam Harbour site. Entering 2025, the mood there is extremely positive. In terms of the debt bridge, this is probably my opportunity to point to the working capital progress. In fact, in a 2-year period, we've reduced working capital by 23%. The numbers there are what was roughly 35 million at the end of 2022, like for like is 28 million at the end of 2024. If the cynics in the audience say, well, that's because you've lost your revenue and your debtor book's reduced, if you stripped debtors out of that calculation, the like for like reduction is actually 34%. So we're pleased with that, and as I said, that is the reason that we've been able to generate more cash from operating activities in a depressed profit year. So that's obviously all good. I'm not going to talk through every bar on there, but in terms of assets purchased, CapEx, 1.8 million of that 3.3 million points towards the development of our web and the materially better experience that our customer base is on the cusp of enjoying. Yeah, that's probably all I pull out from that slide, Mike.
Okay.
In terms of slide 15, I think that's just the first graph there is a nice illustration of the positive trend on the gross margin and the 300 basis points better than previously comment I made earlier. The middle chart there is just bringing to a picture of what I just said, the material reduction in working capital, and fairly obviously the third bar down there, debtors, that's reduced because revenue's gone down. But look at the reduction in inventory in particular, where people that Mike has brought into the business have done a remarkable job in improving our stock turns and just being altogether more grown up about how we manage the procurement and stock holding process. The final chart there on the right hand side, we could have picked many different charts, but I chose to use, this relates to our operation in Skelmersdale, our biggest distribution centre. And what it shows is that over a 12-15 month period, we've actually been able to dispatch more product with 30% less headcount. So I think that's quite a powerful message. 20% more activity with 30% less people.
Thanks, Russ. And then just two other areas, just focusing on the first. Let's just talk about the market and why that has impacted the sales growth levers. Certainly, as a business, we're frustrated with the top line growth, particularly in the second half of last year. But I think it's important to recognise that the sales decline is tightly concentrated within some very manageable areas, and there is very strong confidence that that will recover. And already we're starting to see some signs of that recovery, albeit with recent market events, we've got to see how that washes through. But we'll come on to that, and we'll talk about our risk profile as it links to things like tariffs. But whether it's the British Fluid Power Association trends, the UK PMIs, or manufacturing production, it all points to that downward trend. And certainly for us, that was something that we weren't expecting to continue through the second half of the year, and clearly it did. But on the left-hand side, I think these are the main points that I'd like to just leave you with. When we look at it and assess it in terms of the delta of decline, over 70% of the year-on-year sales decline, we can attribute to 10 large OEM customers, and none of those we believe is a retention issue. Some of that is also still some destocking that's taking place post-COVID, and that's been continuing now since 2023. But we are confident that business will recover. One of those customers is a customer to both FLOWTECH and to Thorite, was running combined at around 8 million if we went back to 2022, and last year did around 2 million. So it just gives you just an understanding of the delta there. Clearly, what that does point to is that we have to do an improved job in driving more new customers, and also driving greater customer diversification around our acquisition strategy. And part of the work we've been doing to build a new digital platform and to build that customer data platform and to link the business together under one FLOWTECH is very, very much to make sure that we're not seeing the impacts of some of those bigger OEMs in the rounds. We've seen some specific industrial verticals being particularly weak. Russ called out, for example, crushing and screening. We would say certainly in the first half of last year, agriculture, for example, in Ireland was also an impacted market. But the list can be quite broad actually in terms of industry verticals that have been particularly weak. And I do think what's important to recognise is that as a business, 2/3 of our business today is servicing the MRO, the more OPEX related, emergency related ordering of customers. So that's where something breaks within a factory or within an industrial environment, and we're on hand to either supply the product or to come and service and repair. And the same goes for a third of the 2/3 of MRO business is where we're selling to other distributors that typically are servicing that marketplace. And 1/3 of our business is linked to original equipment manufacturers, where we have seen either a decline because of destocking or projects and project timelines just being pushed back. And we certainly saw that in the second half of last year, where the business wasn't actually gone, but where we thought we were going to be taking billings in the second half of the year, they've been pushed through 2025. From a product distribution point of view, where we have our high service product distribution area, we haven't seen a reduction in the average order frequency, and arguably even the picks that we've been doing from the fulfillment center, but we have seen a reduction in the average order value. And again, we saw an acceleration of that through the second half of the year. And actually, when we speak to a number of our indirect customers, our distributor customers, they would say that there was a similar trend of things just cooling. But again, customers are buying what they need, but they're not buying the add-ons. We believe from our analysis of our customer base that 95% of the reduced revenue is market driven. And that's not to say that we're solely dependent on the market recovering for us to recover. We are going to drive self-help, and we'll come on to that. But I do think it's an important point to recognise that I think the market reduction has impacted on us. But we do believe we've had a very, very high customer retention rate. And back to the work we've done during the course of the year, the order book was at a far stronger position at the end of 2024. In fact, it was 5.3 percentage points higher than when we had the recording of the order book at the start of 2024, which we think is encouraging. And equally, the sales pipeline, not just in terms of value, but in terms of quality, is far more significant entering 2025 than it was entering 2024. And again, a lot of good work done during 2024, and that starts to help us to be confident about momentum building, albeit on the backdrop of a continually difficult market. And from a self-help point of view, in summary, and again, a lot on this slide, and we're not intending to go through it all, it's there really for reference. But when we think about those 6 EBITDA growth engines that Russ talked through earlier, what we are making sure we're doing is really being quite ruthlessly focused on what we're delivering within each of those. And I'll just call out a few examples, and Russ will help me as we just walk through this slide. Certainly, the launching of the new value proposition to market, has been a real step change, notwithstanding rebranding our business to One FLOWTECH and resetting and restructuring the business around that value proposition. So instead of having multiple brands to market, we have a network of locations with very, very clear capabilities that we're taking to market. I would just also point to the paper-based catalogues that we have been very, very, I'd say, famous for within the UK market in particular, where we provide a white label catalogue solution for several hundred distributors, and they take the catalogue, they wrap it with their brand, and they take that to market. That catalogue was disrupted a number of years ago as we brought together different businesses, and we've been unwinding that, and we made a decision to launch a new catalogue to market last year based on some very, very strong customer feedback, and we've been delighted with the customer feedback as it relates to the new catalogue. 53,000 catalogues being delivered to market, and we're now looking to see how we can take a digitized version of that catalogue through the new web platform, also through a white label solution to our customers. Russ, in terms of commercial excellence?
Yeah, no, thanks, Mike. I've talked about the gross margin improvement. I've done that one. In terms of what I've said about managing working capital and in particular inventory, some people might be saying, Russ, are you overly obsessed with your surname, Cash, and at what expense has that come? But what I can tell you is that if I use Skelmersdale as an example, over a roughly 12-18 month period, we reduced inventory by 15% in Skelmersdale, which is code for roughly £2 million. And within that period, availability improved from the low 80% to 97%. So we've actually improved availability and efficiency, and against the background of material reductions in inventory. And if you were to say, well, at what expense in terms of customer satisfaction? Well, customer satisfaction is actually on an improving trend. More to do under that heading. Hopefully the new website will materially improve sentiment, as we earlier alluded to. But some real strong positives within commercial excellence.
Yeah, product and service expansion, we'll touch on Thorite in a minute. I think the main event here has been the harmonisation across our engineering solution centres, bringing together those different brands and the capabilities of those brands across 11 locations. We're far more unified now in terms of what that offering looks like, and that also bears out efficiency gains and standardisation gains in the way that we build and service applications. And we've also put some investment and some rigor around major projects capability. It's been an area of focus for the business over a number of years, but actually, at times, there is a rob Peter to pay Paul. We win a major project, it distracts other parts of the business. We've decided to set that up in a much more robust way so that we can properly scale our major projects capability. And the example I gave earlier of the narrow water bridge is one such example, and we have others certainly in the pipeline, and another which is being converted, which we're very excited about, where we're starting to see the bearing of our fruits there. On own brand, I think Russ covered it off earlier, but this will be a continued focus area for the business, and we do believe that with continued expansion of that range, we'll start to see continued success. And of course, the new web platform allows us to push that brand and push all of our brands, to a broader customer audience, and that's something that we're excited about. Russ, any more on operating for less?
No, just to emphasise the point I made about the actions we took at the back end of 2024 to take material cost out of the business, and equally to emphasise that we could have operated for even less, but we feel that would have been an own goal, because we do feel we're poised to manage a materially bigger business in the future. So we think we've been balanced and proportionate in terms of all of the decisions we've been making in terms of our OPEX base.
Yeah, and back to the point on culture, I think we're very proud of the work we've done to restructure the business to drive a more simplified operating model. And with that, a fair bit of organisational change. 60% of the top leaders' roles have changed within that model. We've built new capabilities, building an in-house digital marketing competence, building a procurement competence, strengthening some of our group functions, and notwithstanding, we're now starting to see a much more unified team across the organisation with much more clarity on their roles, their accountabilities, on their targets, and as Russ has mentioned, aligning that under the bonus structures and the reward structures as well.
Okay. In terms of Thor, I am mindful of time, but I'm definitely going to spend a minute or two on this slide because I think it's important. Thorite, we bought this business out of distress in August 2024. At the time, our working assumptions were that it was about 14 million revenue with a gross margin in the high 20s, which was far too low, with a cost base that was far too high. And it was losing £1 million, if not more, per annum at the point it went into administration. My background, by the way, 6.5 years here, 25 years as a turnaround and restructuring professional. So I was in familiar territory when this came to market. Long story cut short, we've maintained and we're building that top line. I previously referenced the fact that we achieved the best part of 5 million of revenue in the first 18 weeks of ownership. So, you can multiply that number by 3 and think what we're expecting to achieve in 2025. We've made massive improvements in its gross margin. It's still not at the top of our range, but material improvement in the gross profit margin. And we've taken actions to remove £1 million, if not more, out of its cost base. So fairly obviously, when you do the mathematics around all that, if we inherited a 14 million revenue business with a 7-digit loss, we've held marginally already improved the top line and sort of removed the bracket from the bottom line. It's perhaps a neat way of summarising it. We paid nothing for it effectively, and let me just build on that a little bit. Initial consideration was £350,000. We subsequently paid about £700,000 to settle claims to secure title to stock, claims in respect of reservation of title. And we actually acquired the debtor book because that was a sensible thing to do. We paid 1.7 million for a debtor book that we knew would recover well in excess of 2 million from our point of view, and it did, 2.2 million. So £500,000 upside there. By paying the 700,000 for the stock, we got stock which is fair valued at 2.1 million. And over and above that, we had to go through an exercise of valuing the intangibles, the brand name, 175-year-old name, and the customer list. So that added about 800,000 to the pot of assets. So it's for that reason that we got the 2.3 million negative goodwill as a credit in our separately disclosed items in 2024. Obviously doesn't impact on the underlying profit because it is separately disclosed. But delighted with the progress that's been made, delighted with the deal we did at the outset. And actually, if you divide pretty much all of the numbers I've given you, including that initial consideration of 350,000, you get Allswage, 1 location, not 7 locations, £50,000, not £350,000. West Brom is its location, by the way, and our old friend Negative Goodwill will rear its head again. Probably 1/7 of the 2.3 million of negative goodwill in Fluorite. It's a bit spooky, that divide numbers by 7 point, actually. But it points towards, we think there's more of this to come. People will be finding life at least as difficult, likely more difficult than we have in the last 12 months. And we do have the ability to capitalise on these opportunities. And I think we've demonstrated beyond any reasonable doubt that we've done a good job at Fluorite. And I think we will be able to demonstrate in a few months' time that we've done a similarly good job with Allswage.
Great, thanks, Ross. And just to say that from an integration point of view, we have integrated Fluorite within the FLOWTECH business. We are going to maintain Fluorite as a FLOWTECH company for a period of time because of the importance of the branded market, and we'll obviously review that. But as you can see in the branding, we're very quickly starting to associate everything into the FLOWTECH brand, which is a pretty normal approach. Okay, so looking forward, let's have a look at the 2025 trading and outlook. Sorry, just a word on this picture. This was a major project which we delivered in 2024 with Jaguar Land Rover. So this was a multi-million-pound project to help them reduce their energy consumption, actually, in their testing facility in Gaydon, and just again illustrate some of the complexity of some of the solutions that we deliver as a company going forward. That was a big sustainability opportunity as well, to help a customer to become more sustainable. In terms of the 2025 sales growth levers, and I've put here self-help focus continues, because we do recognise that the cyclical factors near term are probably going to be more limited, but what we want to make sure that we're addressing here is the structural growth drivers that we have in our hands. I'm just going to talk about these very briefly in 4 areas. One is the new digital platform. A new white label software as a service solution is being launched this quarter to our distribution partners, and obviously we'll be looking to scale that up very sensibly. And we want to make sure that we embed that first and make sure that that fully functions in the right way before we start to properly ramp that through. And the same applies to the new UK website, which we're currently in the process of final testing on to be launched during the first half of this year. We'll then look in the second half of the year to roll that out into the Fluorite channel, into Ireland, into Benelux, and also make sure that we start to accelerate our export capability. And that's all part and parcel of that new digital platform launch. Secondly, around product and service expansion, we've got some exciting new product range launches coming down the pipe. We've been working with some big brands that we've not yet had in our assortment, and we're very, very excited to be able to launch those to market. And we're going to be more and more focusing our range expansion efforts towards higher growth target verticals. And we're certainly wanted to make sure we continue to drive our indirect channel. That's very strategically important to us as a master distributor. But we see great opportunities in aerospace and defence. We have core capability here. We've got a lot of MOD specialism in the way that we do our work through our various engineering solution centres. We're becoming very prevalent within utility, waterways and flood defences, with the Environmental Agency investing quite heavily in making those infrastructure improvements. Again, anything that moves within those environments typically has powered assets with hydraulics within it. More broad infrastructure, such as the big bridge projects I talked about. We've had some real success within data centres, a high growth sector, and we've been very pleased to be exhibiting at the Data Centre World exhibition in both Ireland and in London recently, and we see that as a high growth sector for us in terms of the capability that we have. And we're getting heavily involved in transportation. It's very indigenous. We do that within the UK, Ireland, and that's quite broad spread, but that certainly plays very strongly to our capabilities. On engineering projects, as I mentioned, we've got a very strong pipeline. We've got new contracts that are secured for half two delivery, and we're starting to see the scalability taking place as we enhance our capability there, and we believe that that will deliver enhanced EBITDA. And then finally, as Russ has mentioned, the market's fragmented, it's very volatile, it does present increased opportunities, but we are pretty level-headed. It has to be compelling, it's got to be highly accretive in time, and we need to make the right choices as we go on that journey. On market recovery, we would have been sitting here, I think, a number of weeks ago saying that we felt that the market was going to recover within the second half of the year. That's what all of the data pointed to. I think at the moment, the outlook remains uncertain given the current market volatility. But on that, and I guess just in summary, we remain steadfast, determined and confident in our plan, as I said at the beginning. We continue to make our own success. We've got improved momentum on revenue and EBITDA on the Q4 2024 position, and Q1 trading is certainly in line with management expectations. We're confident in our stable and scalable platform, which is now embedded. We have a strong order book and sales pipeline, and as I said before, we've got some nice projects already secured, and we're excited about the opportunity, not just for 2025, but long term, in how do we take what is quite a traditional industry space and digitize that and really start to harness the power of our e-commerce platform as that comes on stream into the second half of the year. Just a question on, I'm sure that will be asked around Trump's tariff. We've got very limited direct impact on the buy side. We've looked at what we buy from America and what we ship into America. So, that is not a material position. There will be potentially some indirect impact on UK and EU-based customers that do export to the US. Again, we're watching that closely, but we do have low exposure to automotive, for example, and a lot of the stock that we do have, currently comes from Europe, and we're currently working with our Asian-based suppliers to manage through any potential risks there. But I think we've demonstrated very clearly as well our focus on gross margin management, and we are comfortable in taking the right actions. And look, there is still possibility of the global downturn, and we have to wait and see what that brings. But certainly from our side at the moment, we're in a position where we're staying very focused on the job at hand. We've got very clear efforts across the team around the self-help, and that will continue as we go forward. So I think that brings us to questions, Russ. So perhaps we can just pick out some questions in the time that we have left, and any questions we can't get to, then we'll certainly circle back and we'll provide answers to those questions offline from this call.
So Mike, what I propose is that whilst you get an opportunity to review some of the questions, there are quite a few of them, I doubt we'll get through them all, I'll pick off a few whilst you're doing so. A pre-submitted question: how much stock do management and the board own? Will you be buying more given the low stock price? In aggregate, the board owns just over 1.5 million shares, which is in the region of 2.5% of the total population of shares. My answer to that is given that we bought shares in and around a share price of £1, probably as little as 90p, probably as much as £1.20, but I'm guessing a little bit. And given that we feel the business is beautifully poised to capitalise on future opportunities, I guess the answer is why wouldn't we on that one? The second question I think I'd answered. It was a question around the culture at FLOWTECH. There's a couple of questions around banking covenants. I think I've partly answered that, but just to expand a little bit, long-standing relationship with Barclays Bank. In the old world I operated in restructuring and turnaround, Barclays were, in my strong opinion, the best bank to be with. But the leverage covenant is the one that tends to get the attention. But within the definition of EBITDA, the bank allows us to include our friend negative goodwill, which is not immaterial. So in terms, I think the questioner has done a calculation in terms of the leverage multiple. That's not quite right for that reason. And equally, the bank has relaxed that covenant in Q4 24 and Q1 25. So we've got healthy headroom within the banking covenant. We haven't breached a banking covenant. We won't breach a banking covenant. And the relationship is really, really strong.
There's a couple of commercial questions in there in terms of competitive landscape and what's happening in terms of pricing levels to drive volume, and there's also a question around our indirect channel and whether we've seen any impact there in terms of our distribution channel. Just in terms of competitive landscape, it is competitive. Arguably there is less potentially less volume out there, and there are examples where we are starting to see some competitors operating and trying to operate at a lower price point. We have to take choices as to when we need to demonstrate our price competitiveness, but we won't do that at the expense of our efforts around gross margin management. We do believe that we have size and scale in the market. We're working very, very closely with our key supply partners and some of those large global supply partners. The market, I think, did get more proliferated over the COVID period, but actually there's some pulling in of that needed, and we're working with our supply partners and opportunities there, which I think is very important. But look, I think in these situations there is always going to be a situation where it's about competitiveness, but there is a danger, and we can see that with some struggling companies we've named on this call, where perhaps we can fall into the trap of dropping prices for short-term gain, but actually it doesn't always help. We don't want to disrupt the market in that regard. In terms of distributors, we continue to be very, very strong in our focus on our distributor partners. It's been a 40-year journey for FLOWTECH to be a key partner to either small distributors, of which there are plenty, both in the UK, across our markets, but also across Europe, but equally some of the large nationals and international players. We're a key part of their supply chain. We're embedded within their supply chain. As their volumes have dropped, our volumes have dropped. We do look now at opportunities for upselling and cross-selling our service capabilities into the distributor partners, which we never did before, and we're starting to see quite a lot of cross-pollination there of opportunity. And we do believe that the shift into more of a digitized place with our white label offering is actually going to be the next stage of that evolution. And arguably that's been perhaps a missing part of our armory, which we're putting right. And our distributors, I think, are appreciating the efforts we're putting in and the investments we're making. Notwithstanding, we will be able to offer them a software as a service to provide them with a very, very strong digital and web platform should they decide that that's where they want to go. Russ, any others that you want to pick up on?
I think we are going to time out, but just quickly, I guess, there's a question about the assumed growth rates in GB as it relates to the impairment disclosure, I think, in the notes. 19.7% growth in GB. Well, the significant lion's share of that is just the full year impact of Fluorite. That's a GB business. It's as simple as that. And outside of that, modest growth assumptions. The secondary question about Benelux, but I pointed towards under new, really capable management with much improved PMI indices as it entered 2025, for example, with some positive trends in Q1. So we're pretty comfortable with the stated 8.3% there. There's some questions about Allswage. Yes, it is roughly a 2.5 million business, which we're looking to progress to sort of 3 million and a decent EBITDA margin in its own right. There's a particular individual who's asked 7 or 8 questions, and I think we could probably deal with at least some of that in a separate call, Mike, in my opinion.
Okay. Okay. Well, look, given time, let's end it there. Can I just pass back to the controller, please?
Of course, Mike, Russell, thank you very much for your time and for answering all the questions from investors. Of course, the company can review all the questions submitted today. We will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which is particularly important to you both, Mike, I was just wondering if I could ask you for a few closing comments.
Yeah, great. Thank you. Well, look, firstly, thank you very much for taking the time to listen today, either live or on the recording. I'll just come back to where I started, really. 2024 was a very, very important year of transition for FLOWTECH. We're very, very pleased with the progress that we've made to simplify the business, to drive customer service improvements, and ultimately to drive a more scalable model, getting those fundamentals in place. We're delighted and proud of the businesses that have joined FLOWTECH over recent times. It is a challenging and tough market. There's no doubt about it. And I guess we've got to make sure that we stay very, very resilient to that. But as I've said on the last slide, we're all about making our own success. We're very focused on growth. We've got the large scale of the transformation complete. And I think we're in a much stronger place now into 2025 than we have been over the past number of years. So we remain very steadfast, very determined, and very committed to the plan that we have. And we're going to go forward with a degree of confidence. And whilst we do recognise that there is very, very strong market uncertainty out there right now, we believe that our business model and the opportunities that we have in front of us do present us with continued confidence to be able to move the business forward positively. So thank you, everybody. We'll come back on the questions. We'll leave it there.
That's great. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. On behalf of the management team of FLOWTECH FluidPower PLC, we'd like to thank you for attending today's presentation, and good morning to you all.